All items, one item on our agenda is listed for discussion only. No action can or will be taken. All members of council are here this evening. And Larry Lang, John Fishbach, you're on.
I'll turn it over to Larry, Mr. Francis.
Thank you and good evening. Tonight, very first part, what I would like to do before I forget is to introduce the finance team that works on our various debt issues, be it refinancing, new issuances, and so forth. Larry Given is our financial advisor with Wedbush Securities. We'll talk a little bit more about his role in a couple of minutes. And Scott Ruby is our bond counsel from Gust Rosenfeld. All of you, I think, or most of you are quite familiar with both Larry and Scott from the previous debt financings that we've done. They've been involved for a number of years. But in case there's any illusion, they're key parts of any strategies that we talk about and that we present tonight. Tonight, what we're going to talk about is the basics of municipal debt refinance. It's a little more complicated than it is a typical refinance. We're going to talk just briefly about the basics. We're going to talk briefly about the City of Goodyear refinancing activities over the past few years. We're going to talk about recommendations from the Citizens Budget Committee that were included in their recommendations to you. And then we're going to go over several refinancing proposals, specific refinancing proposals that we have, just to give you an overview of what those are and what you might be seeing, as well as some staff recommendations on those. So what are some reasons that we would refinance our debt structure for the city? One is to take advantage of lower interest rates. As interest rates have dropped, and I think all of us recognize how much interest rates have dropped, it's an opportunity to look at your portfolio and to see if there's an opportunity for savings. Second one would be to reduce payments, extending them over a longer period of time. Recent examples, we've done that, where we've taken the water and sewer bonds away from GO, put them in the enterprise fund, and extending the payment terms out to be more like a utility debt service. Another reason would be to restructure security or debt restrictions, and we've done that in a couple of our past refinancing. And another one that we put in here, because it kind of links to a proposal that was given to us, would be to shift the method of payback, which would be an example of that, is shifting what fund is actually repaying the money. And we'll talk about an example of that in a couple of minutes. But in municipal finance and bond finance, it's a little more complicated than what you might face in trying to refinance a home or a car loan. There are a number of variables that we have to consider in going through this process. One of those would be, what would the impact be on the property taxes? That's a variable that you obviously have to keep in mind. The second is there's some constitutional limitations of and we refer to them as the 20% and the 6% limitation, but that limits the amount of debt that we can have outstanding, and we have to make sure that we're staying in compliance with that. Bond call dates, that's the earliest date that we can call bonds from the investors. And if you can't call the bonds, that means you can't pay the principal on those bonds until that call date. We've got some bonds that call dates don't come out for another 10 years, and for us to invest securities in that period of time would, at today's interest rates, would not make the deal work. Arbitrage is less of an issue now, but the concept of that under federal law is that you cannot earn more interest on your investments than what you're paying in debt service. Back in some of the heyday years, you could actually borrow bonds and invest at a higher rate of return, and government was doing that, and the IRS didn't have a sense of humor on that issue. And the final one is that I mentioned is contractual issues, where an example of that, we're not going to go into this much tonight, but in the CFDs we have standby contribution agreements. We would have to factor those into this discussion. Advanced refunding is a term I wanted to put in front of you because interchangeably we'll use those terms. That is basically a term that is used to refinance municipal bonds, where you have bonds that are callable at a later date. You can't call them today, so you don't actually refinance and pay it. You do what's called an advanced refunding. And there are particular standards that you have to meet, both from an accounting standpoint as well as from a bondholder standpoint. And then you only have one debt on your books, and that becomes very important. They're very complex, but I, more than anything, wanted you aware of the terminology, that if I say refunding and refinancing, the two, for your purposes, are interchangeable. I think that that's adequate enough. If you want real technical explanations, we have our experts that can tell you that and go through. So I wanted to talk a little bit about how we approach refinancings and how we have been doing it over the past few years. But first, to look at, if you look on the right-hand side of this screen, we show 5 different refinancing transactions. These are transactions that we've done over the past few years for differing reasons. I'm not going to go through each of those, but you have approved each one of these refinancings at the appropriate time for the reasons discussed. It starts generally with our financial advisor, which again is Larry Given. Larry does a preliminary analysis of our debt structure, compares it to current market rates, and determines whether or not there are some potential savings from us or for us. For the discussions that we're having tonight, Larry ran, I'm just going to say, dozens of calculations of detailed, complex analysis to determine whether or not these would pencil out and meet the appropriate standards. And he looked at all of our debt in doing that. The secondary step in there is bond counsel, and that's Scott Ruby, as I mentioned before. Scott needs to be involved all the way on the transaction to make sure we're complying with federal and state laws. Tax-exempt bonds are subject to IRS regulation. Third step in there is the staff, and that we do a review at that point in time for the business purpose, as well as to make a recommendation to you, and that is the fourth step, which is your approval on any transaction. None of these transactions can happen without that approval from you. So with that, I'm going to quickly go through a recommendation from the Citizens Budget Committee. Basically, recommendation number 3 was to restructure current debt. And specifically, there was a sub-bullet under that which reduced the PIC series bonds for 2008 spring training facilities with general obligation funds and rainy day funds. PIC in this is Public Improvement Corporation. It's how we financed the ballpark and also the spring training facilities for each of the teams. This specific proposal is referring to how we financed the Reds facility when that came in. We did an analysis of this proposal, but first, I think some basic things to understand in there. One is that this would use voter authorization outstanding, if it could, for both Parks and Rec as well as some public facilities voter authorization. The second, and I think probably the non-starter part of this issue, is that to issue that would, the concept would be to fund the debt service out of the secondary property tax. In other words, shift the burden away from the general fund to secondary property tax. The reason that's a non-starter is that would be an issue where you would raise the secondary property tax to do that. And I don't think at this point in time there's a lot of interest in any of you to do that. Now, you can still do the transaction and pay for it out of the general fund, but doing it that way there would be little, if any, savings. And in fact, on this other slide, the next slide, we just show 5 different ways that this transaction was analyzed. I am not going to go through each of these unless you have specific questions, but this is the analysis that Larry ran for us in 5 different ways to look at the refinancing And the bottom line is none of these structures made economic sense unless you were to consider a shift of the property tax, and that we would not recommend, and we are not recommending. So the staff recommendation on those specific proposals would be to not refinance the 2008 series PIC bonds with GO bonds or with, if you will, a 2010 series PIC bond. Also, just to reiterate what was included in this budget and moving forward, the staff recommendation consistent with the CBC recommendation not to issue any additional general fund debt that would be paid for out of the general fund.
Real quick, Larry, did you ever get an answer legally whether you could even sell such bonds under the definition of the election that went out?
I think I'm going to give a very general answer from my discussion with both city attorney and bond counsel on that said that they did look at the issue. Well, you're looking, okay.
I'm just listening.
Want to hear what words I'm going to put in his mouth, yeah. Basically, the answer that they've given is if you guys really wanted to pursue that, they could probably defend it. Our recommendation would be that if you went that route, now ours goes broader than legal counsel, it also includes me as staff and others that we've talked about, would be if that were the direction you wanted to go, we would really recommend you go out for a separate election in November of 2011. Just to be clear on that issue.
The only reason why I ask is, in my humble view, and I'm no attorney, that's a major stretch to put that within the recreation facility of the intent, I think, when those bonds were sold. But again, not being an attorney, that's just my humble opinion. That would have been a major stretch to put that in there.
Okay.
Larry, what was the interest rate on the 2008 PIC bonds, and what would be the rate today?
Yeah, good question. The interest rate on the 2008 PIC bonds that we sold was at 6%, which is very high, higher than we had planned on because of the timing in the marketplace, as you may or may not recall. The difficulty in refinancing those is that their first call date on those bonds is somewhere about 2020. What that means is that we cannot pay the principal off sooner than that. So for us to retire those bonds, we would go in, we would have to buy U.S. government securities sufficient to retire those bonds at that point in time. Well, the U.S. government securities are also not yielding enough to do that. So you would be chasing that 6% with a yield of something like 2%. Larry ran the calcs on that, and it really only made economic sense if you were to increase your payments in the short term.
Was that the $5 million combined two PIC bonds that they were discussing? What did they call it? That was from the CBC recommendation.
Yes.
That was the 2007A and 2007C?
No, that's the
that's something different.
2008.
Okay, so we're getting to
The
that part?
2007A and the 2007, actually it was B and C, I believe.
Oh, well, in
from
here,
that
okay, and here it says A and C.
Yeah.
Okay.
B and C from that recommendation would be to take rainy day fund money to retire that.
Correct.
The challenge of that is that on the surface, it sounded like that would save a bunch of money, but there's two different bonds and the timing of the principal on those two bonds. The one that matures at $600,000 a year will, that's the debt service on it, will be paid off in 2013. So that one will drop at that point in time. So that savings is a little bit sooner realized. The other one at 300 and some thousand a year goes out, I believe, till 2020. I don't remember the exact date. Both of those kept the same maturities that the previous debt that they refinanced had. So to actually be able to take that cash, and we can send you the calculations on that, but you would be taking a lot of cash to save what after 3 years would be $300,000 a year. It would start 900,000, but then with the call provisions, it would take a lot more cash than what was calculated.
Okay. What is the interest rate of those?
Those would have been, I believe, I don't have them right in front of me, I want to say those were somewhere approximately 5% because they were sold in 2007 before all the credit markets really crashed, and they may have been a little lower.
Or maybe lower. So with the 5% or lower, and then the fees that you would have to pay in advance of paying it sooner than it's called for. I was just, looking at, our last discussion was our investment policies.
Right.
And if you're only making 2%, but we're paying off a 6%, that would make more sense. But if you're, cutting at it, then it doesn't. Okay. Thank you.
If in November, when we have the discussion about revenue and taxations, that the council believes that that is a use that you want to consider of retiring debt, we can give you calcs to go along with that at that point in time. But I think what you'll find is that the absorption of that cash would not provide the return that you're looking for in these economic times.
I have a question for you, and this may be simple. I may not understand this. So if you can't use the secondary because of the deflation of all the homes right now, is that kind of why? Because is that the chart you showed us at another meeting where the secondary was below in the primary? Is that the same correlation that you were talking about here?
I think that is a good question. The secondary property tax, I won't say cannot. What I'll say is that the secondary property tax at the rate that was adopted this last year is sufficient to pay the obligations that we have against general obligation bonds. If we were to refinance, you would increase that secondary property tax by about $2 million, the levy, which would increase the rate that you would charge the voters. You would have to increase the property tax rate. That's one issue. The second issue, and I apologize for the complexity of this, there are 3 different variables that go into whether or not you can issue bonds. The second issue is voter authority. That's already been referred to. I've answered that. The third one then gets to the constitutional limits. And the 6% limit is where most of this money or a portion of this money would come from. Actually, I think I was told by bond counsel most of this money would come from. The 6% limit, we have a capacity in that limit, I think right now is somewhere in the area of $45 million. What that would mean is when we talked about City Center a few months ago and the timing of City Center with our declining assessed valuation, I think we had an estimate then, I'm going on memory, but I think the estimate then was somewhere under our assumptions about fiscal year 16, 17 would be the timing available. This would delay that about 6 to 8 years from there. And that's part of why I put it kind of in the non-starter category.
Thanks. It just helps me understand where all
and
the charts
those are
we
all
had
good
and
questions
everything.
that you're asking.
Can you in any way impact the callable feature in one of these bonds?
Okay, we'll talk about that with the next. You can't change what you sold, okay? And it becomes a discussion that you have at the time that you're pricing the bonds. And in fact, we've got one that we are recommending to move forward on. So let me go through the 2007 PIC bond analysis with you and see if that answers your question. And if not, let's go back to it. There are 3 different debts that we have outstanding that we believe make sense to do a refinancing on. The first is the 2007 PIC bonds. Those were the original bonds that were used to finance the facility, and I'll talk a little bit more on point here on this next slide.
What was that, the 10 million, or what was it?
This was the 68 million that we did the original, the ballpark and the Indians facility over and above the 10 million.
This was 2007?
Yes.
I thought we were talking about 2008. PIC.
We were in the 2008, but I'm going to explain the answer to your question on the 2007 of how that works on the bond call premium. Basically, let me answer it very simply now then. the trade-off that you get, the traditional, when you go out to the market on bonds that we sell, most of our bonds we sell have a 10-year call date from the day you issue the bonds. That's the tradition in the municipal bond market, okay? So that, what that does is you sell it to an investor, and they're expecting to hold this out for 10, 15 years, and then a year or two later, you come back and say, no, I want your money back. They wouldn't have given you the same return. And so that's why you get a lower interest rate by having a later call premium, okay? In the case of the 2007 bonds, for certain maturities in the middle there was $26 million in the middle, that differential was only 15 basis points. So you recall the discussion, 100 basis points equals 1%. So 0.15%, if you will. So at that point, we made the determination that those middle maturities, it made sense, let's make those callable at any time, because it only cost us 15 basis points. As a result of that, we are recommending, and we are able today in the lower interest rate environment that we're in today, we're able to refinance that $26 million, and we are recommending we move forward on that. But traditionally, it's about a 10-year call when we issue debt.
And the interest rates on those bonds was 6?
On the 2008 bonds, we're 6%.
But on the
that's
7?
correct. On the 7s, we're about 5%.
And what would you expect today?
I don't have my sheet in front of me. Around 4%.
So the 2008 bonds, callback, this goes to 2020, you said.
It's probably 2018. I was just roughly talking out 10 years. I think normally we go 10, so I'm guessing that was 2018.
That was 12.
Yeah.
That doesn't sound right.
Yeah.
So Larry, we're talking about 0.15 of a percent, right?
On these bonds, when we sold them,
So-
keep in mind, 2007, the debt markets were very active, very aggressive, and this one came in, when they gave me these rates, you're kidding.
Back
For
then?
15 basis points, yeah, let's do that.
Yeah, good decision.
Yeah. Yeah, that decision is worth about 1.2 million, as you're about ready to see.
I guess the question is the 15 basis points, is that amortized, or is that based, applied against the 26 million? I mean, over time, the longer you go, does that actually drop down? Or is that-
No. The 15 basis points is your interest rate goes from 5% to 5.15%.
No, and I mean the cost that you're going to have to pay if we call them in.
The cost is zero by calling those bonds. When you paid that 15%.
Oh, I see, okay. So you've already paid.
Made them,
Okay.
yeah.
I got you, okay.
Yeah. Okay, good questions there.
And the 26,000, was that part of the amount of money we spent on the stadium, or is this separate?
The 26 million
Million.
was part of the ballpark and the Indians facility. They were wrapped in one financing. That's correct. The first one on the stadium and then the Indians, yes.
Okay.
So it's just two different issues, similar purposes, sold at two different points in time. Okay. With that, in the 2007 PIC bonds to refinance, you have three different options as to how they are. And I'm going to give it real simple. The top one, in English, you can save the most cash, but it's all at the end in 2027. You would save at that time some $2.4 million in 2027. In today's dollars, that's worth 1.3%, which really has a return of 4.9% present value savings, means it's a good deal. Anything above 2% is where we would recommend it. The second approach says, well, what happens if we spread that between now and 2027? Save you $95,000 a year. The present value of that's a little lower. It's about $1.2 million, so it's about $90,000 lower. And it'd save you about $95,000 a year between now and 2017, or 27, excuse me. The third approach, and our recommendation is to save about $1.2 million, but to save it over the next 3 years. And that, it's all the same transaction, it's just where you want the savings to be spread. And so our recommendation is to have that savings spread over the next three years. Any questions or discussion on that recommendation?
Well, how would that break down, Larry, the 1.2?
The 1.2, if you'll accept round numbers that these aren't exact, about 600,000 would actually be the savings this fiscal year, 300,000 for each of the next 2 fiscal years. And that's general fund savings, of course.
For how many years again?
For 3 years for those savings. The present value savings, the best present value savings is the one where you save all the money in 2027. Given the economy, I don't think that makes sense. And it's only, it's 4.9% versus about 4.55% present value. Well, the present, that's at that debt ratio. So,
Me and I don't know who else.
Will this in any way impact what we're going to get back from the STA?
this will not change the rates for the STA, is my understanding. But before we take this bond issue back to you, we will confirm that.
This should hopefully lower our fixed costs for the next 3 years, our ongoing fixed costs by the numbers he's going. So that'll help the general fund impact from a fixed cost standpoint.
Larry, is this something that then further on down between now and when after we refinance, we can refinance again? Is this something that there is the ability, or is this a one-time shot to refinance?
This one is a one-time shot, and that's really a very good question. Generally, no, not generally. The rule in tax-exempt debt is you can only refinance once. So what happens on this, and the specific structure I don't have in front of me right now, but on this particular one, as far as the call dates, we have to look a little closer at the call dates, because one thing that Larry and I have talked about a number of times as we talk about debt restructuring, both on this and the 2008, we've talked about the timing of the STA payments and the flexibility that's very important for the city to maintain back in, say, about 2017, because those estimates on those cash flow receipts are going to change again between now and 2017. Hopefully they'll improve, but they're going to change. That's one thing I'll guarantee you, because they're based on future rental car contracts and so forth. So if those are changing, that is the time you're best positioned. So we want to leave our options open to be able to restructure as much debt as we can at that point should the need arise.
Larry, when you mentioned the 1.2, you had 600,000. You mentioned this year. Is that this fiscal year, or would the timing actually be next fiscal year for the savings for the
In
payment?
that structure, that would be this fiscal year.
This fiscal year.
That's correct.
So what's it, 633 or?
633 for starting in 10-11, and then 11-12 and 12-13. Round numbers, of course. Okay. The other two refinancings that we are recommending are one, some water and sewer refunding bonds for the existing WIFA loan. That has a very small savings up front, and would only make sense if we did it in connection with other debt issuances. That way you can blend the issuance costs together. If it were standalone, we would probably recommend against it, even though the present value savings is about 4%. The last one on here is the...
So how much is that, the loan?
Total on that one, I believe outstanding is somewhere about $11 million, if I remember right, on the WIFA. And the present value savings is about $300,000. So I'm saying it's really not a
300,000 a year or 300,000?
present value, which is what it's worth today. So it's not a burning refinancing that we need to hustle out and do. The next one is, however, and that is the Gila River Indian community obligation that we have for the water. That is carrying an interest rate in excess of 8%. If I've ever seen a refinancing that looked good in my 150 years in municipal government, it's this one. The present value savings on that one is 24.3%. So this one is really the easy one. The net present value savings on that is about $2.5 million.
How much?
2.5 million. So we're coming back with this one. We're going to blend that with, probably with the WIFA loan one that I referred to above, but also with any new money issuance that we would do this year, which are already included as part of our debt plans, to consolidate for efficiency in the transaction. So that will be coming back to you, I'm assuming you support these recommendations.
Why wouldn't you recommend the PIC at the same time?
The PIC would be a different transaction. I can see that one running on a separate time frame of its own.
Okay, thank you.
The last one that you were just speaking of, do we see that in the general fund, or do we see that in the enterprise?
That's in the utility funds.
Utilities, okay.
And as you'll recall, we had some consternation about how we were going to pay the interest on that obligation a couple years ago as we went through the budget, and that really helps alleviate that. Some of that is paid back by impact fees. Unfortunately, they've slowed down a bit, but this present value savings will help those utilities.
What was the interest rate on that?
The assumed interest rate, I believe, on the subordinate lien was about 4.5%, if I remember right. Yeah, the existing one was 8.25%, and so it was just a huge savings.
Larry, does the GRIC own that, the paper on that 8%?
Yes. And legal counsel.
Sorry, I didn't hear the mayor's question. What was your question?
I was asking if the tribe, Gila River Indian Community, do they own that paper at 8%? And they do.
They do.
That's my understanding anyway, and legal counsel has discussed with them opportunities to negotiate us pay down at a discounted amount, and I think they didn't have a sense of humor on that issue.
What are they going to say? Do this.
My understanding is that we control that.
Excuse
The
me.
question asked is, what are they going to say when we do this? My understanding is
There's options for paying it off, yes. It's built into the agreement. You can prepay it in full.
Okay.
So a summary of our recommendations then, proceeding with the PIC Series 2007 refinancing, proceed with caution on the WIFA loan refunding. I told you they're interchangeable. I just kind of noticed I put two different there, but they're interchangeable, and then proceed with the GRIC agreement refinancing. With that, I'll take any questions you may have.
Everybody support the three ideas?
Yep. Okay, thank you.
Okay, council member reports, or shall we wait to the meeting? Okay? Same with the manager? Yep. Okay, meeting's adjourned.